So the U.S.-China great power competition has moved from codependent trading partner status to strategic rivals, and then to Cold War nemesis, and now possibly ending in a kinetic event over the Taiwan Straits. I mean, that's almost daily you hear about it. Anti-CCP is the one topic that the Democrats and Republicans can not only agree on, but play one-upsmanship with it. So we are witnessing a growing fracture between the two countries with increasing aggressive language, policies, and actions from both sides. And there's a real chance that the US will prevent most direct investments in China and under the guise of national security, and perhaps to even delist all China domiciled company on the US exchanges and prevent any US dollars from assisting China's growth and aid competition. So, China approximately represents 30% of the MSCI Emerging Market Index. With all that is going on a daily basis, and regardless who wins in 2024, what's your thought about investability of China? If it is investable, how should we think about it? How should we think about it? If it is not investable, quote unquote, because I understand many large institutions are asking firms like yours and others to say, gosh, I'd like you to create a China-only investment and then sort of an index ex-China and let us decide what to do. So the world is going in from an investment standpoint already fracturing. I mean, when we think about it, we no longer say, oh, just give me an EM index and I'm good. If it's 30% China, I'll go with it. I'm just thinking out loud, and hopefully you can help me to think correctly about investing in China. Is it investable? And even if we don't have China in EM, China plays a huge role in many parts of the global South. So your thoughts on that?
Yeah,
please.
Well, first of all, Philip, our house view has been, and I'm not going to lie, I've been a personal driver of this as well, is that China does not belong in the EM index, and it doesn't belong in your EM portfolio either. It should be a standalone. But not only for the geopolitics aside, the pure fundamental macro performance and positioning of China is so different from any other region in the world, it deserves its standalone allocation. It's the only other region outside of the US that can drive its own macro cycle. So we can all be lowering rates across the world, China can be raising them, and vice versa. And that's exactly what we've seen the last few years. Yeah. We can be stimulating fiscally while they're tightening, and the reversal. No other country can actually run against the tide, swim against the tide in the same way, and therefore it deserves its own standalone allocation, just on its own, on those fundamental points. Yes, it's certainly investable. It's back to the points I made earlier, which is, are you getting compensated for the risk you're taking on? Because you are taking on risks. Obviously, you don't have any doubts about this. I think most of your listeners are very well aware. You're taking on considerable risks, and some of them are very idiosyncratic and very particular to China, and you definitely need to be compensated for that. And we continue to see in the public markets opportunities and valuations at levels where we feel like, yeah, this is attractive. This makes sense to be holding it. But obviously, the price has to be right, and it has to sit in the right dimension of your portfolio. I do have concerns as a foreign direct investor, because that's where the risks are greater with regards to basically the downside risk is certainly much greater than you have in public markets. It's illiquid, you cannot repatriate, you're exposed to a variety of additional regulatory legal risks that typically are not present in public markets. That's usually also, it's that opportunity set that makes foreign direct investment so attractive. But the other thing is, that's the China risk, but you also have geopolitical risk, which is that the US really, you talked about US dollars going to China. What we really don't, or what US authorities don't want, is US technology and expertise going to China. Sure. And that usually comes with direct investment. It does not come with portfolio dollars. It does not come with you or I putting a slice of our retirement money allocating it to the Chinese stock market. No knowledge transfer or technology transfer occurs in that process. And so therefore the risk is also from that front, in terms of kind of from the home front, is lower. Now, the other thing I would argue also with policymakers is that because that's so, China does not need our dollars. China is a net creditor to the rest of the world. They earn more from the global economy than they pay back in. And so what they do need, they continue to need, is growth and moving up the value chain in terms of their export mix. And for that, they need direct investment. They need engagement with the global capital markets in order to help that process along. But that means that, again, portfolio investment, investing into public markets, equities and bonds, bears considerably less risk than the private market angle, direct investments, private equity, real estate, where you actually have onshore assets directly that are heavily exposed. It doesn't mean there's no risk. It just means there's less risk. And so I am currently comfortable with the amount of risk. Why? Because I know the Russia case gave us the sense that things can turn overnight. But remember, even in Russia's case, the US warned about an invasion 3 months before the war. All of us were talking about it several weeks before. And so you as an investor could have chosen at that point to say, I'm no longer comfortable with that and I will repatriate. Well, in the Chinese case, I think we would get a lot of signals along the way that risk is rising. And there would be repeated opportunities to reevaluate and examine, are we still comfortable with our allocation? Would we like to reduce it? Would we like to zero it? And so therefore, I'm comfortable with investing today. We may have this conversation 6 or 12 months from now where I tell you the opposite, but that's because of events over the next 6 to 12 months that would drive that decision making. Particularly Taiwan, you mentioned Taiwan. I think it's really important to understand that kinetic event over Taiwan is a worst case scenario. And yes, in that instance, I'd be not only worried about my China portfolio, but probably most of my portfolio, because a kinetic event over Taiwan, it's hard to see how that stays contained without spilling into a global depression greater than the 2008 financial crisis.
Yeah.
My final message on Taiwan is that between what we have today and a kinetic event, a war over Taiwan, there's a lot of gray in between and a lot of different stages, kind of like think of it as an escalation ladder where we could find ourselves. And whenever things shift, either right before an event or you as an investor will have time or the ability to respond. So some people will say, well, I was completely surprised by the Russia invasion. Yeah, frankly, even I as a so-called professional did not expect it a month earlier. But I would not say I was surprised that the war happened the day it actually did happen. And therefore, I knew that the morning, once it did happen, I also knew that the immediate consequence would be full-on sanctions and exclusion from global capital markets. Therefore, we spend time talking about geopolitics because we see news flow, and that news flow can give us signals for whether to reposition or adjust portfolios based on the risks.